Hello, future millionaires. Welcome back to the Get Rich Slow podcast. We are your hosts, Adrian Shermer, Rob Delavan, and Lance Johnson. How you guys doing this morning?
Just peachy.
Nice.
Hey, great there, Adrian. How are you?
Oh, thank you. I'm doing very well. I'm excited for this show today. You can find us online, Apple Podcasts, Spotify, Audible, Amazon Music, multiple other platforms, including YouTube, if you want to see our smiling faces while we tell you all about today's exciting topic, rising interest rates. What does it mean for home buyers and sellers? Before we dive into that, though, I want to talk a little bit about some wins. Rob, you had a success to share with us?
Yeah, I'll try to keep it brief. As you guys know, I'm so good at that.
Yeah.
We had a project. This is in the Portland metro area market. There was a real mess of a house. Had to do a ton of things just to get it like slightly average. And eventually priced this thing out at, I don't know, about 525 was what it was comping for, based on a number of different things, the condition, the fact that it backed up to a somewhat busy road, and it was a struggle of a property just in general. We actually ended up reducing the price down to 475 after a couple of price reductions, aggressively based on the way the market was responding to us. And as soon as we finally hit the right price, which was 475, the market told us that we were at the right price by giving us multiple offers again, which we haven't seen for a few months. And we were able to work that through to the end, ended up with a cash buyer, and actually were able to basically not give any concessions. And even though the property still needed a lot of work. So it was a big win for the client. They were able to move on and had to sell. And you never want to be in that position in a declining price market, which we're in. They were in it regardless and had to sell, and we made it happen. And it was a big win, especially on the negotiation side. It could have been another $30,000-$40,000 less, based on factors and conditions of the house. So
What did it go for?
It ended up at 475 on the dot, and with no concessions.
Yeah.
And previous buyers, we actually had a fail sale before that. They were trying to get us to like do $60,000 or $70,000 in concessions based on condition things. So we just worked all that up front, and they were happy buyers and happy sellers, and on to the next one. So it was a fun story.
Nice job.
Yeah.
All right, so we got some upcoming events that are coming. We have our Santa event that's happening Saturday, November 12th. It's at the ROI Delavan office off of Lower Boones Ferry, and it's between 1 and 4. And really, this is kind of exciting. Everybody has their routine during Christmas, going to the mall and stuff, and things are getting expensive. So we're providing a opportunity for our clients and our clients to bring friends and potential clients for us, and just kind of have a nice event. We like those social events, and bring the kids or the grandkids, and have Santa there and take some pictures. This is the first one we're doing, and so we're excited about it, and we'll build on it and have an alternate lower cost means for our clients and friends to do that Santa thing.
Hey, there you go. It'll be fun. Yeah.
A little more relaxing environment than the mall, too. I mean, if that's your thing, that's your thing. People in Portland love standing in lines. Don't get me wrong, but
there you go.
I'm gonna say this is more my vibe.
Yep. Okay.
So let's jump back into it. In today's podcast episode, we're going to be talking about really unpacking an article from Costar Economy that is titled "The Housing Market Faces a Painful Correction." If you don't know who Costar is, they are the largest commercial real estate information and analytics provider. So they're a great source of information. I like the articles that they publish because I feel like they're very data driven. Yes. And so that's more fun for us to talk about because we can kind of fill the gaps with our ideas, but use real numbers to base our opinions off of.
Right.
All right. So based on this article, this graph here, what trends are you seeing in the market now that interest rates have peaked, maybe not peaked quite yet? They discuss in depth the impact on monthly payments for home buyers. How are you advising your clients, Adrian?
Yeah, absolutely. Awesome question. And I love this chart. If you're listening, please check the resources on this article, because the data, again, is what I think is fascinating and what drives, where our mind goes on these. You can see the direct relationship between the orange line on this chart that runs from 2000 up to today on housing affordability, that index that we've talked about in previous episodes. Try to create a reference in this show here. Avery, our fantastic producer, if you can help us add that in there. Um, Affordability is a calculation, of basically a monthly payment average as a portion of averages in income in our country.
Right.
And obviously, when you see interest rates drop, that affordability index, without any other factors changing, that affordability index is naturally going to go up. You can afford more house for your dollar with a lower rate than a higher one. Sounds obvious. But the impact of getting so close to, not zero really, but the lower that number goes, the greater the multiple is when we see a rise again. So we've got a situation where there's two ways to look at it. You can look back at the peak and you can go, oh man, I really wish I got that 2.5 that I heard, my brother's cousin's best friend's dog got. Or,
Hey, I got a couple of those, Adrian.
do we have yeah, I was
I
lucky
think
enough to
Lance
buy
did too,
a couple of years ago too.
Right.
But we're seeing, I guess, a return is what I see when we look farther back in the trend line, and when we look especially all the way out historically. Housing is still affordable, but we're going to start to lose. Gosh, I had so many buyers who skipped the first home, the starter home. They went straight to 4-bedroom, or 3-bath, giant homes with really low down payment. I had so many conversations. I remember, especially last 2-3 years, of people going, "Oh my gosh, I can afford that much. I'm approved for that much." And now the correction is, it's gonna hurt a little bit, right? Because it sucks to know that was an option. I've got a chart that I'd love to include in our data as well, that I built in just an Excel spreadsheet that takes rates and loan amounts and compares payments. The difference between a 3.5% rate and a 6.5% rate, is nearly $1,000 in payment on $500,000 worth of borrowed money. So,
yeah. In this
and that's
article,
almost 50%.
In this article, Adrian, it specifically talks about like a national market. And remember, we're in the Portland metro market, but regardless, it's looking at national trends. And it was saying that roughly that 3% rate, which we've experienced pretty easily in the last couple of years, and you can see on this graph here, for a $400,000 house to get the same payment, that same home at 6+% where we're at now, that same house would have to be 300,000, which 25% reduction, which is nuts. Man, that's a tough thing. So that's, and we haven't seen that drop yet. And in the further conversations here, we'll talk a little bit more about that. But it's just it gets harder to afford the same home is really what it comes down to. So
yeah, it's kind of interesting because in 2013 is when I bought my house, current house, and I remember looking at. It took me 4 years to buy my house. I looked at 200 homes, made 50 lowball offers between 09 and 13, and got into contracts with some, and then backed out, or they backed out, or whatever, didn't, and then finally negotiated, got into a contract with a house, and then called. This was my first house, and then called. But like at 13, it was the best affordability because interest rates were coming down, but nobody was buying the $1.5 to $2 million homes, right? And builders were all these expensive homes that these builders had, they were foreclosing on them. It was just really interesting. And now the flip's going to happen. Like, the properties are high, the interest rates now are high, properties are coming down, but like can't afford it, right? And so there's going to be less buyers. This is a very interesting time that we're going to be going forward. Something like our grandparents faced back in 1950, and then went into the savings and loans where they bought a house and stayed there for 30 years, because interest rates are rising. They can never make the next move.
Yeah. So when I interrupted you there, Adrian, as far as the advice to the clients, and you alluded to it, but buying that smaller starter home, that townhouse, that sort of thing.
Yeah.
Return
Return to more traditional, the step-based purchase. Or, I love this phrase. I'm gonna be sad when it's gone. Marry the house, date the rate, get into a property, accept the cyclical nature of the economy, accept that this is, and we can dive more. I think when we talk, Lance, we got a question for you in forward in the episode about this, but these are adjustments that are made by the federal government. There's a reason that we're seeing higher rates, and it's not something that should sustain. We shouldn't be seeing these rates forever, but waiting out that time by getting into a house, building equity, and then having the opportunity to refinance and have a lower payment while you still have that home. You've also got a lot of people who bought. I mean, the advice would be just buy 2 years ago. Hop in your time machine. But
right.
Those people who have that equity and who already have a low loan, they're not going to refinance to grab their equity. But over in the recent, home equity loans aren't like a brand new product, but they have become more popular in use. I think we'll also see people tapping the equity if they want to use it. They're going to borrow at a higher rate, but they're going to borrow only that little extra chunk there. You might have bought a house 2 years ago. I've got lots of clients who got six-figure equity by buying right before some of that wave died off. And people may be leveraging that along with their savings from COVID, from the pandemic. It'll be an interesting time.
Which is actually the perfect segue into
well, in one brief moment, it'll be interesting to see, like, there's a tiny house movement that's going on, right? And I wonder if that it'll be interesting to see if that accelerates that. They're tiny houses that are mobile. And you might see people taking that really small start, get into the tiny home, and then get into multiple land deals, and then move up, and then eventually buy build their house and stuff when they're ready. It's going to be a very interesting time to watch.
Okay, so this is actually a great segue into this. So the question 2, this one's for Lance. So this graph here is titled "Real Wages Are Declining." And as you can see, it stated that average weekly earnings grew by 4.6% from August 2021 to August 22. Yet, so has the cost of living, which, the whole inflation conversation and so forth. While, tons of households were able to accumulate, savings rates and so forth during the distribution of pandemic relief, and that whole thing, which we're coming out of now in the fall of 2022. Solid and persistent consumer spending is leaving less available for those big down payments. So obviously, we need to pick your brain here on the thoughts rise of inflation, cost of living, and we've already talked about potentially starter homes versus and so forth. But this is a huge issue. So what are your thoughts on inflation, cost of living, as it relates to the declining real wages here? And where that takes us.
Well, yeah, it's a great conversation. There's just so many parts to it. So let me just break it up into a couple different parts. The biggest thing I can teach somebody how to do as a financial advisor is, if I can teach them to save 20 to 25% of the gross income, no matter what their income is, and we realize that a family of 5 in the Portland metro area, if your combined income is 60,000, that's not going to go very far, right? And to try to save 20 to 25% is going to be really difficult. But let's, one of the things I pride is I get my clients within that 2 to 5 year period of time, trying to strive for at least 20, if not 25%, depending on how many kids they have and whether they're going to education and how much they're going to pay for that. Well, with rising inflation, there's a couple factors. With that inflation, will your income go up? So you're seeing clients getting 11% raises, 12%, 15%, because during the pandemic, they didn't have raises, right? And so if those raises are occurring and inflation's happened, you're probably still going to be able to save that money. But if you didn't get that raise and you're saving, and all of a sudden now groceries are 20% higher, travel is higher. There's going to be some tough discussions about how to reduce expenses. And or you might have to change the amount you save, right? It's not rocket science. You make X, and there's four levels of spending: savings, committed, discretionary, and taxes. So the next stage is, we have a 2025 sunset on our recent tax situation, which is the lowest tax rates we've had in America. Well, if that should go up and inflation should go up and the income doesn't, and buying a house is getting greater, there's going to be some pinch points on your ability to save and get ahead in the market. So there's going to be some real conversations about what your ability to save and how you're going to spend your money, because we've had interest rates come down and you could refinance and solve all the problems. But now with interest rates going up, you're not going to have that ability to refinance out of your problems. And so there's going to be some real gut checks if people don't live within their means. And those old ways of getting out of those things are going to go away. And so there's I think people need, more so than ever, are going to want to annually look at cash flow, look at where they're going. And if they're not nipping that butt, meaning that there's just not as much money to go around, something's going to give. If not, your consumer debt's going to go up and so forth. And then, you might be forced to sell versus refinance out of your problems and stuff. And so there could be a set of problems that we won't be able to solve based on refinancing because your housing was going up and your interest rates are going down. Well, we could have the opposite effect. Your housing might be going down or flat, but your interest rates are going up, your expenses are going up, your savings is getting less, and you can see people getting in the future into some real problems that they can't refinance out of. And so we're going to have to be careful with our clients and advising them to stay out of debt, and that's going to be hard.
Tell us some good news there, Lance.
Well, I mean, the good news is people are making more money than they ever have in the past, but that might go down. I mean, corporations, your housing values, there is real equity that you had since 2013 when I bought. I mean, there's my house has appreciated well over $1.5 million. That's real money if I wanted to take that. And even if it was dropped 3% from the height, I'm still 3% of a really large number. And so there's just, we're going to have to be, as consumers, we're going to have to be smarter, because we had some economic things that allowed us a simple way out of our problems. And in the future, we're just going to have to be smarter. It's just the way it is.
I've done a number of those, the debt consolidation, home loans. I mean, they were awesome because you'd be lowering someone's rate on their primary at the same time. So a lot of times we tuck 30, 60, $120,000 worth of credit cards into this mortgage, and the payment would still go down. So it was just a reset button for these people, because they needed a refinance anyway. When I started a decade ago, we had the HARP loans. People were even upside down in their houses. They were allowed to refinance through this government program, HARP, MH, making homes affordable. There were a couple names out there for it, but same thing. It gave people a lot more breathing room. And I totally agree with you. Maybe
so
someone has equity now and they can do the
though,
home equity line, but then they're just kicking the can down the road, right?
Right. Well, the real issue is that person that accumulated the 120 still has a bad problem. And that problem is they live beyond their means.
Yeah, there's a hole in their
so
bucket.
you were able to fix that problem, but you were able to mask that problem.
Yeah.
Put a Band-Aid on it. You didn't really solve
I fixed the symptom, but they still.
Right. So now when that symptom still happens, you're not going to have this. And so it's going to be a lot more devastating to people. And so my scenario with clients is, let's address the cash flow issue and let's make some hard decisions about, and before you get too far, before you get $60,000 or $120,000 in debt, because now you're not going to have those same opportunities to refinance out of your problems.
Right.
So yeah, we're just gonna have to be better.
All right, Rob, I want to pick your brain now. Based on the graph that we're looking at here, we're showing home prices may have fallen since May, is the title at the top. This is one running from January 2018 through September 22. And let's talk about these trend lines that you see here. It's stated that the median home price has declined 3.6% since its peak in May 2022. What kind of advice are you giving your clients to prepare them for the shift in the market?
Well, there's a lot here. The fun part about this particular graph, for those of you that are viewing this, is the spread between the median price, right, the number of overall sales, and so forth. The simple advice for clients is preparing them for this shift as it's happening, is looking at, okay, so, and these are national numbers, 3.6% down since May of 2022 when we peaked. And this is through August. And we're always looking backwards a couple months. We're, recording this in October. And what I'm looking at is the trend and saying, and this is just comes from experience, this isn't data driven, up past August, because we just don't have the data. Is the feel, though, is I'm saying, hey, we're probably losing 1% a month, is what I'm feeling going forward based on experience. So if you have to sell a house, man, you look pretty good on this trend line, median price, seasonally adjusted, since, this goes all the way back to 2018. We were going up a little bit. And then, in the last couple of years, we've gone up, 20+%. So at some point, the farther out you go here with this correction, is the farther you're going to lock in that, or have a harder time locking in those gains. So if you have to sell, let's look at other options. Maybe you should talk to a financial advisor. See what else you can do. But if you do have to sell, let's do it quickly, is what we're basically saying, because we are dropping this fall, this winter, and probably for the next couple of years, as long as interest rates are continuing to be a driver of higher monthly payments. We expect a correction, and the correction is happening, or at least we feel that that's happening. And the statistics seem to bear that out as of right now. I don't think there's anybody out there nationally from an economic standpoint that's saying, oh, hey, maybe actually the housing market is magically going to go turn around tomorrow and go up another 30%. Like, I don't know that anyone's saying that. And the data from this article, which we're pulling from, is certainly not showing that. So, if, with that said, if you're looking to buy, okay, let's look at what your dollar can get you. Let's explore that conversation of date the rate, marry the house, looking at what it would cost to purchase the house now with closing costs and so forth. You're going to refi, so there is going to be another set of closing costs potentially in the future. You probably want to bake that in when you're doing your projections for financial advising. When you're also looking at, okay, what can I afford right now if I have the luxury in life of timing the market? They tend to bottom in the winter, and then year over year, they tend to come back up a bit in the spring. The overall trend is probably going to be an adjustment because of, again, back to interest rates, which are driven by inflation to a certain degree. You start looking at, when would I want to buy? And you start having that conversation. And frankly, it goes back to, if you're having that conversation with just your real estate broker, without your lender, without your financial advisor, without your tax professional, CPA, what have you, then you're probably missing the boat. So I'm having the advice of, number one, let's look at the trends. Number two, let's look at the why of what you want to do, whether you're buying or selling. And then number three, which really should probably be number one, let's sit down, make sure you have a plan, talk to your team. And again, that's the financial advisor, the tax person, the lender, and let's see how we can game this out in such a way that you're going to do the best you can given the current market conditions. So that's
no decisions
mine.
without data, right?
Right.
That's I mean, I'm all for moving on instinct on your gut, but your gut
Sure.
should be an informed gut, right? Like you got to have numbers in front of you, and you got to understand what you're getting into.
Right. And that's the fun part, with working with both of you. Lance, your clients, they save. That's the core tenet of everything that you do is they're savers. Well, savers generally are really good clients from a lending standpoint because they're strong borrowers. So, if I can give any advice for those clients, it's start setting yourself up. If you're playing poker, you got a 52 card deck and aces are high. How do we get more aces in that deck instead of only 4? Let's put 40 of them in there. So, and the way you do it is long term. So, planning
play poker
and being strategic. So that's my, I don't know, short, long answer. What do you guys think?
Well, I mean, you're looking at different clients. So you got clients that already have existing houses,
right?
And they grow out of their new house. One thing we really have, and this is kind of a tangent, but like one thing that I'm not a fan of in Portland is this high densification. So back in the 1950s, people had, acre lots. And so what they did when rising interest rates occur, they just, they built on a 400 square foot addition or a new garage or whatever, right?
Yeah.
Instead of redoing the whole shoot match, the whole house. In this densification, you can't really do that. So, one of the things I tell clients is, hey, you're probably going to get some good deals on some bigger lot, older houses now. And, you might be better off getting a deal on that and remodeling because you're going to be able to grow into it, or if you've already done it, they're going to be sitting really nice going forward. Right. Whereas the 4,000 square foot postage lot, there's really no room. And you have a 3,000 square foot house built 2 stories. There's based on the lot lines, you're not going to be able to do things. So, it's just going to be an interesting market. Real estate is very big, and I'm a proponent of real estate, and there's going to be a backlash in time where, there's going to be some negative effects to it, right? And then when it gets down to that low point, there's going to be a buying opportunity. It's just going from when are we at that peak to when we're going to be at that bottom again, and going from point A to point B. That was an answer for reconsolidation with lower interest rates. That option's maybe not going to be there anymore.
Right.
And so there's going to be some basic financial stuff that we're going to have to get better at and look at different options, I guess. So
yeah. And what's fun about
and people might sell, like, even though you're selling off the high, 3% off the high, you still went up 20-something% the last year, way above the average. Or the last 2 years, it might be a combined 30%, 40% gain. And I'll take 3% off a 40% gain and pocket the money and pay off all my debts. And, there might be some interesting scenarios there.
Yeah. And what's fun about this graph is, you mentioned it right there, Lance, is there's going to be an opportunity as the orange line, which is the median price seasonally adjusted, is going to cross over, like, from the number of actual sales. It's going to cross over again, like it did back in, it looks like here is roughly between May and September of 2018. And when it crosses over, there's going to be buying opportunity. There's going to be more homes for sale and more volume in the market. And
back to be a buyer's market instead of a seller's market.
Exactly. So it's cyclical, and these things cross over. And when you're crossing over, that's when there's opportunities one side or the other.
Right.
So
yeah, you want to have your lines of credit in place. You want to have, you're going to see more of that. You keep your main base rate, and then you're probably going to do more lines of credit to be able to fix some things. And then you're going to focus on paying those off. But what you really don't want to do is get yourself where you're underwater cash flow wise. Your cost of living, you can't do savings in the future. which then can't reduce the taxes, and expenses are going greater. And then now your house becomes too expensive for you. And that's why you're working. And then what happens is your backup plan, what are you going to do if, what's going to follow is eventually things are going to get to a point where there have to be layoffs and stuff like that, and so we just got to make sure clients are prepared. And if they see a trend where it's not, maybe they do sell right now and take advantage of it. And maybe it's the time to rent now, there's just a lot of different things. Maybe it's time to not be in, a densified rural area with where the urban growth boundary props up the price, right? And maybe you live outside those growth boundaries.
Right.
All right. So final thoughts. How do you take advantage of a drop in the market? The people that have a game plan are excited about the opportunities that are in front of us. Everyone else is holding pattern, wondering what to do. We help our clients create a plan. We're taking advantage of the opportunity that's here and now, and we can talk about that. And if you're ready to take control of your money and your time, come see us. Let's see what the possibilities. And I think one of the things here on this is, when I meet with clients is we analyze the good and the bad of your rentals, the good and the bad of your current home, what equity, what are the things to prepare you for. We've had a great run in the market, real estate and stock market. So the law of averages says if we have 12 great years, there's probably going to be a couple of years that's going to be tough. Right. And then are we prepared for that? And if we are prepared for that, when we get to where the market is really attractive for real estate and other rentals and vacation rentals, we want to get those clients prepared. And we want to make sure that if there is a layoff, they got backup plan on backup plan on backup plan. So you want to know what would happen if that happens. And yes, real estate's going to do what it's going to do, the stock markets. And one of the things we know is in any given time, it's going to be one person's menace and the stock market or real estate and another person's benefit, right? And so we're just hoping that we could teach our clients how to, unfortunately, take advantage of an opportunity and get yourself prepared for that. And so we're excited about it.
I love it. Let's play chess instead of checkers, huh?
There you go.
Excellent.
All right. Up on screen, for those watching on video, we do have links to our websites. If you want to get in touch with us, getrichslowpodcast.com is a portal to access all of our collective information, as well as a catalog of financial tools and links to the articles and charts referenced in this episode.
Awesome. Thank you so much for listening. Appreciate you guys.
Yes, appreciate you guys. Nice job, you guys.
Bye-bye.
Good to get the team back from a summer layoff.
There you go.
We'll see you next time.
We'll see you next time.